In 2013, an elevator to shareholders Warren Buffett revealed how his money would be invested if he were to pass, so his wife didn't have to worry about investing it herself. To the surprise of everyone, his investment strategy was extremely simple. His trustee was instructed to use a simple 90-10 asset allocation strategy, where 90% of the money would be invested in low-fee index funds like the S&P 500 and 10% of the money would go to short-term government bonds. Now this strategy contradicts the standard investment strategy that experts recommend to those investing for their retirement. Experts normally suggest that investors should have a strong equity holding like stocks when they are younger and add more bonds to their portfolio as they get older to protect their money from potential market downturns. Many experts use the 100 - your age rule. This rule suggests that the balance of your portfolio should depend on your age. So for example, if you are 30 years old and you use the 100 - your age rule, you would have 70% of your money in stocks and 30% in bonds. If you are 60 years old following this rule, you would have 40% in stocks and 60% in bonds. The idea behind this strategy is to protect your money as you get closer to retirement. Age. Stocks have a higher rate of return than bonds do, but are also much more volatile and are vulnerable to market crashes and recessions. So following this strategy is known to have a few benefits. It will help you grow your wealth faster when you are younger and protect your money when you are older. Stocks are vulnerable to market crashes, but when you are younger, a market crash doesn't affect you as much. Since you have more time until you retire, you can simply just wait for the market to recover and your money is back in your portfolio. This is why these traditional investment strategies aim to have more bonds as you get older. These don't get as high of a return as stocks do, but they are much less volatile. So as you get closer to retirement age and you begin withdrawing money to retire, you wouldn't want a market crash wiping out half of your retirement fund. So as you age, you don't have as much time to wait for a market crash to recover. So bonds offer that stability, but with lower returns. Now this is standard strategy in the world of investing and retirement planning, which made Warren Buffett's investment plan that much more controversial. And Warren Buffett's strategy suggests having 90% of your money in stocks and 10% in short-term government bonds, regardless of age. But how does Warren Buffett's strategy actually perform against traditional investment strategies? Well, Spanish finance professor Javier Estrada from the IESC Business School in Barcelona decided to test just that. He decided to put Warren's strategy to the test to see how it performed against traditional investment strategies. During historical returns, he tested how a $1,000 investment would perform with each strategy from 1900 to 2014, over 100 years of data. This is what he did. He tested the performance of a variety of investment strategies, including Buffett's, and 30-year intervals, since that is roughly the time people spent retired. He took into account a 4% yearly withdrawal rate, which is the standard for retirement. And once per year, he rebalanced each portfolio. In this experiment, Strada collected data from 86 different intervals using a variety of retirement starting points. What he found was quite unexpected to traditional investors. But before we get to that, let's give a huge thank you to our sponsor, Public.com. Public is an investment platform that helps people be better investors. On Public, you can invest in stocks, ETFs, and over 30 different crypto from Bitcoin to Shiba Inu to Apecoin. Public also stands out with their community feature. Given that the market is going through a lot of turbulence at the moment, I like that. On Public they have an interactive social community, where I can share ideas and chat with millions of other investors, creators, and analysts. You can actually follow me at the Butterman Project or many other investors in the app to see what trends they follow. Public also holds regular live town halls, where you can ask business leaders questions and see them respond directly to you in real time in the app. And the best part is, when you sign up at public.com/the Butterman Project or click on the first link in the description of this video and make a deposit, you get a free stock with a value between $3,000 and $1,000. You see, Public puts their investors first. They don't sell your trades to market makers or take money from payment for order flow. So again, make sure to go to public.com/the Butterman Project or head down to the first link in the description of this video to get your stock worth between $3,000 and $1,000. You can see the full disclosure down below. Now let's get back to see how Warren Buffett's strategy performed against traditional investment strategies. Warren Buffett's strategy, despite criticism, did quite well and was surprisingly resilient to market crashes. The strata found what he called failure rates for all the different categories. Failure rate simply means that the retiree ran out of money before the 30-year cycle ended. The 100-0 strategy, or those who had the money invested only in stocks, had a failure rate of 3.5%. This is likely due to retirement during market downturns. But on average, this category ended up with the most money at the end of the 30-year cycle, more than tripling their original investment even with the 4% annual withdrawal. Those in the 90-10 or Buffett strategy had a much lower 2.3% failure rate, but the performance was quite strong. This category ended up with the most money out of any strategy that included bonds only, outperformed by the all-stock portfolio. The 6040, which is recommended for those entering retirement, had an astounding 0% failure rate, which means no one in this scenario ran out of money before the 30-year cycle ended, regardless of market conditions. Although the strategy is the safest, it did not produce the most money out of the three, and ended up just with 26% more than it started with. But things get a little disastrous once you put more than 40% bonds in your portfolio. Those in the 4060 split had a 3.5% failure rate, and those in the 3070 split, meaning 30%. Equities and 70% bonds had a shocking 12.8% failure rate. Also, every category that had more than 40% in bonds ended up with less money at the end of the 30-year cycle than they started with, even if the market was doing well. So what does this all mean? For one, Warren Buffett's strategy is quite strong and has a fairly low risk of failure. The advantage of the 90-10 strategy is that it's a middle ground between the strong growth of aggressive methods like the 100-0 strategy, but also provides you with the downside protection of a more conservative approach like the 6040 strategy. Now Professor Estrada did come up with a twist to add to Buffett's strategy to eliminate or, at the very least, lower the failure rate of the 90-10 strategy. This way you protect your wealth even in a market crash. Estrada recommends keeping an eye on the stock market to decide how you will withdraw your money. He says that if the stock side of your portfolio performed well over the last year, you can take out your normal 4% withdrawal out of the stock side of your portfolio and then rebalance your portfolio back to the 90-10 ratio. But if the stock did not perform well, you should take your money from the bond side. This is because when stocks are down, you want to hold on to them instead of selling them so you can give them time to recover in value. If this happens, Estrada recommends not rebalancing your portfolio until the following year to allow time for your stocks to grow back in value and take advantage of future stock growth. But what do you think? Would you rather have more profits with more risk or less profits with more safety? Let me know in the comments. And as always, thank you for watching, and I will see you in the next video.